IRS 2026 tax changes, the one big beautiful bill, and what U.S. companies in Canada must know. Here's something every U.S. company operating in Canada needs to hear right now. 2026 is not a normal tax year. Between new IRS legislation, shifting compliance rules, payroll reporting changes, and a shrinking IRS workforce, this filing season is shaping up to be one of the most confusing we've seen in years. And confusion in cross-border tax? Well, that's where mistakes get very expensive. So in this video, I'm going to walk you through what's actually changing for U.S. companies with Canadian operations and the 5 key strategies you should be thinking about right now to stay compliant and protect profits. So let's get into it. Hey, I'm Duncan McPherson. I'm a dual qualified CPA in both the United States and Canada, and I spent most of my time helping companies navigate the messy middle between the IRS, the CRA, and everything that can go wrong in between. And I'll tell you this straight, when major US tax law changes hit, cross-border businesses feel it first, and they usually feel it the hardest, especially in a year like 2026. You may be asking, so why is 2026 so different? Well, let's start with the big picture. The legislation people are calling the One Big Beautiful Bill isn't just another routine tax update. And by the way, the same dynamic is happening up here in Canada. The CRA workforce is dropping. Now think about that for a second. More rules, fewer agents, more automation. That combination always leads to one thing: computer-driven enforcement and less room for error. And that matters even more when your business touches both the US and Canada. So what should you actually do about this? Well, call me for one. But there are 5 strategies I want to walk you through today. First thing is this: get absolutely clear on your compliance footprint before tax season begins. With retroactive law changes in place, you cannot afford uncertainty around entity structure, payroll treatment, cross-border reporting, or your prior year's filing positions. Because when laws change after the fact, the companies that suffer most are the ones that never documented their positions clearly in the first place. I've seen this over and over again in the last 30 years. Clean documentation is no longer best practice. The second strategy is this: treat payroll reporting as a high-risk audit zone for 2026, especially when it comes to tips and service income. The updates tied to IRC 224 signal something very important. The IRS is tightening visibility into real-time compensation reporting. And for cross-border businesses, payroll confusion already exists between U.S. reporting and Canadian payroll withholding, treaty exemptions, and shadow payroll situations. Add new IRS scrutiny on top of that, and payroll becomes one of the fastest ways to trigger trouble on both sides of the border. This is an area you want reviewed before, not after, you file.